Why ESG investing is becoming controversial everywhere. A decade ago, ESG sounded harmless. Environmental, social, and governance investing was sold as a simple idea. Invest in companies that do good, avoid the ones that do harm, and still earn competitive returns. Pension funds liked it. Universities adopted it. Big asset managers wrapped it in glossy reports filled with wind turbines, diverse boardrooms, and smiling children. In the United States, ESG has become a political flashpoint. In the UK, regulators are quietly pulling the brakes. In Australia, superannuation funds are facing open backlash from members. The same framework that promised to clean up capitalism is now accused of distorting markets, undermining democracy, and reshaping society without anyone voting for it. So how did something that sounded so reasonable end up so controversial? The answer starts with how ESG actually works in practice, not how it's marketed. At its core, ESG investing claims to measure non-financial risks. Things like climate exposure, labor practices, board independence, and corporate ethics. The logic is simple. Companies that manage these risks should be more resilient in the long run. That idea alone isn't radical. Investors have always cared about risk. The problem begins with who defines those risks and how. There is no single ESG rulebook. Instead, there are dozens of rating agencies, each with its own models, assumptions, and values. One firm might rank a company highly for environmental disclosures, while another penalizes the same company for its supply chain. A tech giant can score well on governance while being criticized for social impact. The same company, same data, completely different ESG scores. For investors, that inconsistency isn't just confusing, it's dangerous. Because when trillions of dollars rely on these scores, small assumptions turn into massive capital flows. Companies aren't just being evaluated, they're being nudged, pressured, and sometimes punished based on criteria that are often subjective and opaque. This is where the controversy really begins. In the US, critics argue ESG has crossed a line from risk management into political activism. When state pension funds divest from fossil fuels, critics ask whose values are being enforced. When banks restrict lending to certain industries, lawmakers question whether financial institutions are acting as neutral intermediaries or unelected regulators. Several states have responded by banning or limiting ESG mandates in public funds, framing it as a defense of fiduciary duty. Across the Atlantic, the tone is calmer, but the concerns are similar. In the UK, regulators worry about greenwashing. Funds marketed as sustainable often hold companies that look anything but. As scrutiny increases, firms are rebranding ESG products, watering down claims, and preparing for stricter disclosure rules. The fear isn't ideology, it's credibility. Australia offers another angle entirely. Super funds there manage retirement savings for millions, and members are starting to ask uncomfortable questions. Are these ESG screens improving returns, or reflecting the preferences of fund managers rather than contributors? When energy prices rise and resource stocks outperform, the trade-offs become impossible to ignore. And that brings us to the most sensitive issue of all: performance. For years, ESG advocates claimed there was no downside. You could save the planet and your portfolio at the same time. Sometimes that was true, especially during periods when tech and growth stocks dominated. But markets change. Energy shortages, inflation, and geopolitical shocks have exposed the costs of excluding entire sectors. When ESG funds underperform, the narrative shifts. Suddenly, it's about long-term horizons. But retirement savers don't live in theory. They live in quarterly statements. There's also a deeper discomfort, one that's harder to quantify. ESG concentrates power. A small group of asset managers, index providers, and rating agencies can influence corporate behavior on a global scale. They vote on shareholder resolutions, shape executive incentives, and define what good looks like. That level of influence, exercised quietly through capital markets, makes people nervous, not because the goals are evil, but because the process bypasses public debate. It became controversial because it blurred the line between investing and governing. And once that line fades, trust starts to erode. And that erosion sets the stage for what comes next globally today. That erosion of trust is why ESG is now facing resistance not just from politicians, but from investors themselves. What began as a voluntary framework has slowly hardened into something closer to an expectation. Asset managers aren't simply offering ESG funds. They're embedding ESG criteria across entire portfolios. And that shift has changed the conversation from "should we consider these factors?" to "who decided this was mandatory?" This is where the backlash accelerates. For corporate executives, ESG has become a moving target. Targets are set, redefined, and raised again. Today, it's carbon disclosures. Tomorrow, it's supply chain audits. Next year, it's political spending or speech-related policies. Many leaders privately admit they're no longer optimizing for customers or shareholders first. But for ratings agencies they've never met, compliance replaces innovation. Box ticking replaces strategy. Investors notice this. Markets are efficient, but they're not immune to distortion. When capital is guided by signals that are only loosely tied to cash flows, pricing breaks down. Entire sectors can be starved of investment, not because demand disappears, but because capital is redirected elsewhere. That creates shortages, volatility, and ultimately political consequences, especially in energy, mining, and infrastructure. This isn't theoretical. The past few years have shown what happens when supply is constrained while demand remains stubbornly real. Energy prices spike. Governments intervene. And suddenly, the same institutions that pushed ESG principles are being asked to fund the industries they discouraged. In Europe and the UK, this contradiction is becoming harder to ignore. Policymakers still support sustainability goals, but the language has shifted. ESG is no longer framed as moral progress. It's framed as risk management again. That's not an accident. It's an attempt to pull the framework back from ideology toward pragmatism. Australia is following a similar path. Super funds haven't abandoned ESG, but they're becoming quieter about it. Less marketing, more disclaimers, more emphasis on member choice. When retirement savings are involved, symbolism has limits. In the US, the divide is sharper. ESG has become a proxy battle for something larger. Who gets to shape economic priorities in a democracy? Supporters argue that markets should price long-term social risks. Critics argue that those risks should be debated and decided by voters, not embedded silently into capital allocation models. Both sides claim to be defending the public interest. And that's why this debate isn't going away. Because ESG sits at the intersection of finance, politics, and culture. It asks markets to do what governments often struggle to do: enforce long-term discipline. But markets aren't designed to reflect collective values. They reflect incentives. When values are imposed through incentives, the system pushes back. The irony is that many ESG goals are widely supported. Cleaner environments, transparent governance, fair treatment of workers. The controversy isn't about the destination. It's about the route taken to get there. When progress feels imposed rather than chosen, even good ideas trigger resistance. So what happens next? ESG doesn't disappear, but it fragments. In some regions, it becomes softer, more voluntary, more disclosure-based. In others, it hardens into regulation, openly political and openly contested. Investors grow more skeptical. Labels matter less. Fundamentals matter more. The era of unquestioned ESG enthusiasm is over. What replaces it will be messier, more honest, and more openly debated. And democracies work best when value judgments are argued in public, not outsourced to spreadsheets. If you found this breakdown useful and want more deep dives into how money, power, and markets really intersect, consider subscribing. Let me know in the comments how ESG is being discussed where you live, in the US, the UK, Australia, or elsewhere. I'll see you in the next one.